Okay, I'm gonna just revert back to the old style for this week because there are just so many really good questions, and the I was doing screenshot after screenshot, and I thought, okay, stop. Let's just scroll through the comment section and just don't answer the ones you don't want to. So let's begin. And if I don't know the answer to something, the beginning of knowledge is the words I don't know. Uh, with a good reading for PCE, why TLT or bonds don't run so much? So what we've had in the last couple of years is we've had a market that has been dominated by narrative, right? I'm sure you're sick and tired of hearing that word. What's the dominant narrative? Why is this stock moving? This is the narrative. Why is this doing this? This is the narrative. It's not. We're not saying what are the fundamentals anymore. We're saying what are the narratives. And when you have narrative-driven stocks or narrative-driven markets, it can override a lot of the fundamentals. And then you end up going from data point to data point, as opposed to looking at holistically. Every data point becomes the narrative, right? So if you had a good PCE reading, that's the narrative, and we had a great day. If the next day you get somebody saying, "Oh well, there's no way we're going to get to 3% deficit. We're going to be at 6, maybe even 7% fiscal deficit to GDP next year." Well, then PCE is gone. That data point is gone. That's the new data point. That's the new narrative. And so you lose sight of the fundamentals because you're so narratively driven. And this market has been so narratively driven. Some stocks are almost completely narratively driven. Some asset classes are almost completely narratively driven. And narrative is hard to beat, is very hard to beat. How much negative news? Bond markets have had so much negative news in the last 2 years. When will this finish? I don't know. That is a good question. It never finishes. Put it that way, because there's always a future. Now tomorrow's the future, but when we get to tomorrow, the next day's the future. There's always a future, and prices are discount the future, and there's always a future every single day. But what I expect for 2025 is increased volatility. I don't know that you're going to get a good direction on volatility until you know what the new Treasury Secretary's plans are as far as the deficit and over what period of time. You're also going to not get a lot of clarity until we find out what Trump's plans are in terms of taxes, which will probably take about a year, in terms of spending, which we'll probably get fairly soon, and in terms of tariffs, which will then dictate something about growth. So there's just so many uncertainties, and the problem with Trump is he doesn't like to reduce that certainty. He likes to increase the uncertainty. Keep them guessing, keep them guessing. Markets don't like that, so I expect more volatility through 2025. I expect the narrative to continue, and we will go from data point to data point to data point, which means you have to look at the economic calendar to say, what are my risk events this week? Because they're all risk events. Anything that has to do with duration is a risk event because it could reinforce the existing narrative or completely change it right then and there until the next data point. Very frustrating. Bitcoin mining video that for your applied level. I already replied to that one. Does it? This is a good question. I actually like this one. Does it make sense to care about traditional valuation metrics such as discounted cash flow and PE multiple when analyzing companies such as Tesla and Palantir, which clearly ignore valuation? Well, I don't know that they completely ignore valuation, but they do stretch valuation quite a bit. For Palantir, I did a video understanding cybersecurity stocks. PE is the wrong multiple, and same with the discounted cash flow is the wrong multiple to look at for cybersecurity companies because they invest a lot to get a contract which has a stream of revenue for a period of time. Well, that revenue is recognized over years, but this cost is recognized this year, making the net income look rather terrible because a lot of the cost of getting this contract should be matched against these revenues over time. And they're not. They're incurred in the period. So you'd use either rule of 40 or rule of X, with rule of X I think being the better one to value it. even with that, Palantir is against its peers very overvalued, but it has a very visible CEO. Most of the other companies have sort of very rational, middle of the road CEOs. Not this guy. If you ever seen an interview with this guy, doesn't have any boundaries in what he wants to say. He says exactly what he's thinking. He's not political at all, so that, because of his authenticity, kind of attracts a bit of a cult of personality. That is probably partly in the price. And we don't have to talk about the cult of personality when it comes to Elon Musk. What this is good for is, let's take Tesla. And you say, well, 140 times forward earnings, clearly that is ridiculous. If we call it a tech company, all the tech companies are somewhere around 30 to 40 times forward earnings, which is itself stretched. So you can say, rather than looking at discounted cash flow, where you forecast revenues, you subtract your cost of goods sold, you have your expenses, you get all the way to net income, divided by the share count, and you get your EPS, and then you figure out what your multiple is. Go the other way around. So it's still useful, but you just go the other way around. You say, well, instead of 140, what would it take to be at 40? So you take the price, you divide it by 40, you'll get your EPS. You have your share count, so you can figure out what your net income is, and then travel up towards revenue. And all along the way, figure out what assumptions you need to make that work. What would have to happen for earnings to be such that the current price is 40 times those forward earnings? So you'd have to make some estimate about margins. Are margins expanding or are they decreasing? If margins are expanding, then revenues can grow at a lower rate to get to your EPS. If margins are decreasing, you're forecasting higher and higher growth revenue, or revenue growth, sorry. Also, it may be that you have to bring new products forward. Maybe a robotaxi isn't 2027, and maybe it's not a 50-50 chance. Maybe it's a 100% chance it's mid-26. And maybe you're forecasting that have to be half as successful as Waymo is right now within 6 months, and growing at the speed of that to just, so you know where I'm going with this. You can see what assumptions you need to justify that multiple, that price at a multiple of 40, and say, does that make sense? So you're not working your way down the income statement. You're going to start here saying, well, that's a multiple of 40. What needs to happen on the way up? It's just a reverse discounted cash flow, right? So it is useful in that sense. Then you can sort of look at your assumptions and say, well, is it realistic that margins are going to increase 300 points, revenues are going to grow by 40%, the robotaxi will be mid-2026, it will within 6 months be half as successful as Waymo and grow at the same speed? You can then ask, will that be successful? Because the market will give you the fundamentals every 3 months. Tesla has to come and present its fundamentals every 3 months. However, there's still the value of the relationship with Trump. That's probably got $100, $150 onto the price of Tesla. How do you value that, right? But this is a good exercise. Start from the bottom, work your way up. For your last outlook of 2025, please do an all-in style superlative video. Some ideas: biggest investment surprise, biggest winner, loser. Yeah, I guess I could throw in like the top 5 list of some of those kind of things. Sure. Any rebalancing by fund managers after the start of 2025 will bring long-term capital market yields down, push the price of TLT up. TLT has had a bad year while equities have had a good year. If you're rebalancing back to a strategic allocation, you would expect some selling of equities, some buying of TLT. But I think for tax purposes, a lot of that is done in the fourth quarter, right? You want to get that in before the end of the year. So chances are, being that we're past the Christmas break now, or in the Christmas break, that repositioning probably has mostly been done. I don't know that they would wait to the end of the quarter to get it done. I think they'd take advantage of saying, well, we got to reduce our equities. Let's sell some of our losers. and then go into duration, but that does not necessarily mean they're going into the 20-year and 30-year bonds. They may say, the middle of the curve is better for us right now, the 3, the 5, the 7, the 10. Maybe they're going in there instead. So, I wouldn't say that they're waiting until January. They're going to sell equities and buy a 30-year bond. I don't think they'd be there. So no, I wouldn't expect that to be, I'm sure there's some of that going on, but I wouldn't expect it to be a tailwind. Following Lennar this year, curious about the recent CBO report suggests privatization of Fannie Mae could affect the dynamics of supply and demand in the U.S. housing market. They're at the end of the channel, so probably not. The supply could be greater than before, with foreign investors bringing capital to support the drop of interest rates, reinforce mortgage applications. Well, so the federal funds rate has dropped, money market rates have dropped, but mortgage rates have gone up. That's what's important. Mortgage rates, not interest rates, mortgage rates. And it's the supply and demand at the level of the buyer. The level of housing sales and the level of mortgage applications are not currently being held back because Fannie has a shortage of money, right? If that were the case, then new money coming in could unlock a lot of potential, but that's not the case. They're not being held back by that. So I don't see that it would change anything in terms of the housing market. Fed cut the target rate by 25 basis points, but cut the reverse repo by 30. Now in line with the lower bound of the Fed funds rate. Thoughts on why the Fed made the extra 5 basis point adjustment? Well, when you have the reverse repo at $2 trillion, what you don't want that doing is rushing into the market all at one time. But we are now less than 100 billion, so what does it matter? The market could absorb that 100 billion easily without changing any rates in the market beyond the target rate that the Fed has set. It wants rates to be between 4.25 and 4.5, right? And if you had $2 trillion and that had to find a home in the market, if you paid it, if you're paying at 4.3, it probably has a nice return sitting in the reverse repo. But if you say, well, we're going to match the lower bound, well, why wouldn't I go into the market at 426, 427, 428? You might even, if you try to push $2 trillion in the market, you might even push the lower bound down, and the Fed would have to do more work. But 100 billion, that's not going to move anything. So why not save a little bit of money, right? I don't see it as a big deal. Reverse repo probably will be zero by mid-January, end of January, and then all we'll be looking at are reserves. How do you consider how much premium should be enough for you to enter or sell an option? Premiums on TLT, how would you measure if risk I'm taking is worth the premium or if it's subjective? Well, TLT, the way I would do it is there's a certain amount of margin that you have to keep whenever you sell a put. And you could take the premium divided by the margin. You could see what that is, and then you just can multiply it by the number of days to expiration over 365 to annualize it, and you could see what it is that you're getting. When you get an annualized number, let's say it's 6.3%. If you want to compare all of these things, if you're trying to do some kind of analysis to see where you're getting the best return, you will find that if you just keep taking higher and higher volatility stocks, you will get higher and higher premiums, but it also comes with higher and higher risk. So whatever you have, whatever annualized premium that you get, 6.3 is rather low though, to be honest with you. You can sometimes get it like 30% annualized is not uncommon, divided by the implied volatility. Divide them all by their implied volatility, and you can then rank them. And if you take TLT, and you can do this at the money, or you can say, well, I'm going to use 20 deltas on every, I'm going to look at 6 or 7 different things, take the 20 delta, it'll have a certain strike. Figure out what margin you need and what the premium is per contract. How many days to expiration divided by 365 to get an annualized number divided by the implied volatility. And if you rank a whole bunch at 20 delta, you'll get some idea. They're not all the same. Some offer significantly higher return per unit of volatility, right? So what you would get over here is the annualized return per single unit of implied volatility. And since you've controlled for implied volatility, you would take the one that has the highest premium or annualized return per unit of volatility. That's not TLT right now. If oil prices stay low, shouldn't oil refinery companies benefit from it? Well, yeah. I mean, as far as an input cost, that would be to their benefit, sure. All oil refinery stocks are down and around good valuation in my point of view. Small cap stock in that sector down over 60 to 70. 2016 oil prices going down. Oil refining stocks did really good, did really well. Let's get our grammar correct. They did really well during that time. Why this time it keep going down? Well, so you have a refinery, right? A refinery has inputs and it has outputs. Input is crude or a type of crude oil. Every refinery takes a specific type of crude oil and it has outputs. The big output is gasoline, of course, but it has a whole bunch of other outputs as well. So if you have gasoline at $3 and oil at 90, and oil drops to 60 and gas drops to $2, you got a 33% reduction in your inputs, but you also got a 33% reduction in what you're selling. You're now only selling it for $2. Gasoline prices have been coming down at the same time as oil prices have been coming down. I'm not an energy expert for refineries, but I believe the critical metric to look at for refineries is something called the crack spread. You might want to Google the crack spread, C-R-A-C-K, the crack spread. And if depending on if that is changing, it could either be changing positively for the refiners or negatively, independent of the price move of oil, because that's an input. If you have lower cost of inputs, it will put, because of competition, more pressure on your outputs, and you'll have lower prices for your outputs. It's the spread between them that matters, not so much the value or the levels of each. So you might want to Google crack spread and see where that takes you. Oh, it's a long one here. Silly question. Would it be ridiculous to also consider that if undocumented immigrants are indeed deported, while their labor is lost, perhaps some existing housing does free up? While shared homes with documented immigrants is a likely scenario for many undocumented immigrants, I agree with that. Is this still an effect that could slightly counteract things in terms of putting home builders under slightly more pressure as they face the potentially slightly higher costs from contractors, while also seeing more existing supply fill in gaps? Potentially higher costs or more supply. So what you're saying is you get rid of some immigrants, you're going to free up some housing units, even if they're apartments. You're still going to free up some housing units. I'd say mostly apartments on that. And while it will be more expensive to build some units, it will be rebalanced by the fact that some supply will come on. I would seem to think that a mass deportation would be more of a threat to apartment REITs in the U.S. than to home builders. I don't think they're coming into the country undocumented and then buying homes. I don't think that's what's going on. I don't think they're the marginal buyer. So I don't think that it's going to help. It is going to hurt in the sense that immigrants make up a large part of the construction industry labor force. And of that labor force, a not insignificant amount are undocumented. Whether that means they're illegal, whether they're in the country illegally, is a different question. You can be undocumented but still be in the country legally. So I don't know that those numbers are very helpful. I think Trump is going to carry through on his promise to deport, but it's going to be, I think, hierarchical. It'll be the worst of the worst gone first. Oh, look at that. That rhymes. The worst of the worst gone first. That's the beginning of a poem, isn't it? It'll be that, because that's big visibility, and that's a big story, and that's something that he can point at, say, look what we're getting done. We're making America safer every day, and it'll be the worst of the worst, so that the news reports will say this person committed this crime, and they're gone. This person did this and this and this, and they're gone. And that may be enough to detract attention from not, dragging Luis out, who is a good worker, and the companies need a whole bunch of him. Otherwise, things are going to get uncomfortable for them. I think that's how it's going to work. I mean, that's what I would seem to think is a rational move to make. I guess this supply freeing up would be more likely renters. Yep. I wonder if there's something here that results in the urgency of home buyers to stay lower than expected. Don't think so. Even just more rentable supply brings rents down, could push potential first-time buyers to delay. That's something that would not happen very quickly. I don't know that I would make that my thesis. I'm thinking it's shaping up that this undocumented deportation will be a nothing burger. Yeah, I'm pretty sure it'll be like that. By the way, if you're looking for really good nothing burgers, A&W. Probably what Lennar thinks too, I'm guessing. Hawkish talk, but implementations will be on flows into country and violent criminal undocumented immigrants rather than on too much non-violent. Yeah, that's pretty much, we're on the same page there. Recent interview, question from a quant-elect trading role, one of the global asset management firms. Regarding 100 murderers in the field. Oh, it's one of these. Single bullet in your gun. Murderers have non-zero probability of surviving. He, she will attempt to escape. Murder is certain death. He, she won't try. How do you stop them from escaping? Okay, so let's put this in perspective. Quant electronic trading, so your answer has to be along those lines. You need a quantitative answer. And they provided you with data. Non-zero probability of surviving. They will attempt. Certain of death, they won't. So what is your task? Your task is to get all those probabilities to zero. Your probability of surviving is zero. You got to get them all to zero. What do we know about them? They're murderers. What does everybody in that field know? That everyone else is a murderer. So they know, there's no issue with, will this person kill me? They will kill me. And so we can use that. You could point your gun at one of them and say, if any single person attempts to escape, I shoot you. And maybe that person then turns to the next person and says, if anyone tries to escape, I'm just going to kill you before this person kills me. And then you could hope for a cascade effect. No, that I don't think that'll do it, because now you're bringing in a psychological aspect to something that's purely quant. Oh, I got one. What if you put them all in a circle? I mean, I'm not told the parameters here, so I'm not told if I can tell them anything. But I would have them stand in a circle, all facing the person in front of them. Yeah, so put them all in a circle, all 100 in a circle, and say, if anyone in this circle attempts to escape, I'm going to shoot the person behind. This person, now I don't have to worry about a cascade effect. because this person here will make sure that this person doesn't move, and this person doesn't want to get shot, will make sure this person doesn't move, and this person doesn't want to get shot, will make sure this person doesn't move. If they're like this, and I say I'm going to shoot you, this person then has to say this. They have to create their own network throughout here to make sure nobody moves. I've already created the network, and I've given everybody a 0 probability chance of surviving based on the action of the person in front of them. That if that person moves, they will be killed. So they're motivated to make sure that person doesn't move, and it'll cascade on its own. I don't know. How does that sound as a solution? Are you concerned about USD strength that just seems to keep going? At some point, it's going to be a problem. The US dollar has been stronger, but yeah, at some point it will be a problem. If we think about, some countries need US dollars. So they have to keep buying those US dollars. It becomes more and more expensive for them to buy those US dollars. And they have to buy those US dollars because they may be importing commodities, mostly energy, that are denominated and paid for in US dollars. So that becomes hugely expensive for some countries to get done. I know Costa Rica has US external debt. So they need US dollars, but the central bank controls the currency exchange rate and has pushed the currency exchange rate up really high, or you could say really low, that you're at about 497 colones to the US dollar right now. A couple of years ago it was 700, 497. So from a Canadian perspective, because the Canadian has dropped against the US and the colony has increased against the US, Canada to Costa Rica is super bloody expensive right now. Is really expensive. Almost anything you can buy in Canada, you're going to pay in any supermarket, you're going to pay double to triple for in a third world country, in Costa Rica. It's super expensive. Costa Rica relies on a lot of tourism for its US dollars. If it's not getting it, it has to do this. It has to get more and more US dollars from the ones that do show up there. So it at some point that can't keep going. So a strong US dollar will hurt the weakest people in the chain. Cost of production involved in Bitcoin. Production will slow dynamically as mining rigs are taken offline due to cost of production and yield. We can't look at Bitcoin the same way we look at gold. Gold has a cost curve. So this is what the cost curve looks like. This is called the all-in sustaining cost, and every gold miner lands somewhere on this cost curve, and then you have a price of gold. These will produce, these will not produce. And if the price of gold drops, what happens to supply? The supply drops. If the price rises, what happens? The supply of gold increases. However, no matter how high the price goes for this miner over here, it will not affect their marginal cost of production. Their marginal cost of production remains unchanged. Even if you get a whole bunch of miners that suddenly come online, this mining company's cost of production will not change. So their share price will be a function of the gold price. Because as the price of gold goes up, because their costs will not change, their margin goes up. As the price of gold comes down, their margin comes down. That's basic gold mining. If the price of gold dropped to $1,000, you'd have the price of gold down here. All the mines have a cost higher than the cost of production. Supply would drop to zero, which would force the price back up again. That's easy to visualize. Bitcoin doesn't work that way. So we can't talk about the cost of production as a stable point. It is a Nash equilibrium. And the perverse thing about Bitcoin, because it has negatives. Everything has positives, everything has negatives. If you point out something saying, look at all the positives, let's say, yeah, but what are the trade-offs? Everything has a trade-off. The trade-off for Bitcoin is that the marginal cost of production ends up being a Nash equilibrium. And a Nash equilibrium is a suboptimal equilibrium from which there is no escape, because no one is motivated to do anything differently. unless everyone else does everything differently. And you end up in this suboptimal equilibrium. And for Bitcoin, the higher the price of Bitcoin goes, the more suboptimal the equilibrium gets. That is different from gold mining altogether. So if Bitcoin were at 1 million, you'd have an extremely inefficient suboptimal equilibrium. If Bitcoin were at 100, you'd have a far more efficient equilibrium. And here's the thing, it would not change the supply of Bitcoin one bit. No matter where the price is, it would not change the supply of Bitcoin one bit. It would not change the operation of the system one bit. There is no reason Bitcoin needs to be at 1 million. It would operate the exact same way at $100 a Bitcoin. The exact same way. However, as the price goes up, you end up in this Nash equilibrium that is suboptimal, from which no one person cares to escape. No one single miner says, okay, I'm gonna make the decision to do this instead, because unless everyone made that decision, it would for that one miner be suboptimal. So you end up in these suboptimal equilibriums that end up with a momentum of their own, and they usually get worse until they destroy everything around them, which they will. Bitcoin is a nuclear financial weapon that is, as the price goes up, you could say its yield is getting bigger and bigger, right? Right now, it's got the power to take out a small city in terms of if it blew up now. Let this keep going, it has the potential to take out the world. The great financial crisis would look like a joke compared to the destruction that this would cause when it does. Not if. It's not a question of if. As the price goes up, the equilibrium becomes more and more suboptimal, up to a point where it's that suboptimality that will destroy everything around it. That's the trade-off. There are always negatives. So production will slow down dramatically as mining rigs are taken offline. All that does is it just changes the suboptimal equilibrium. It doesn't really do much. So not quite. Where's our next one here? Loss reduction elimination video applied series. You mentioned options can always outperform if you roll options. True. Recently, Newmont, Oxy, BCE, you didn't use options for the exit. Can you explain your thought process? Well, for BCE, that one is easy. You can always gain premium by rolling options up to a point. Delta is the big thing that you got to be concerned about, and the options in Bell don't have a lot of time value. It's mostly just intrinsic value, so there's not much of a pickup for tying up that capital. It's just me waiting around. You got to cut that dividend. Anybody can see that you got to cut that dividend. They should have cut the dividend this year. They would have been rewarded for it. But they raised the dividend, and when I first introduced Bell as something interesting, I made that point with a question mark, saying I don't know why they would do this, but they did. The debt reduction was the big thing. They sold Maple Leaf Sports, $4.5 billion. The market rewarded them for that because the belief was that will go right to debt reduction, and it didn't. They went and bought a company that provided no cash flow until 2028. They more than likely overpaid for the company. And all it did was make the debt to EBITDA better without making the debt any better, simply because Maple Leaf Sports was not consolidated, but Ziply will be consolidated. And when you consolidate it, you find out that your debt to EBITDA ratio improves a little bit. But you haven't paid down any debt at all, nor have you generated any. It was just a financial trick. It wasn't anything strategic or operational. So that was a boneheaded decision. Not to cut the dividend is another boneheaded decision. Every analyst, I think, is on the same page on this one. It's like, you're going to have to cut the dividend. Yeah, look for Bell to be in the mid-20s, low 20s by the time they decide that, yeah, we better cut the dividend. Look for activist investors to start eyeballing this thing. Look for a change in management. I think management is the problem here at this point. So the delta on the dropping price moves faster than any time value that's in the option. So in Bell's case, it wasn't worth it. For Newmont and Oxy, I could keep going on them, but I was already pretty much in gain position anyways with the options that I had been playing over the year. Both Newmont and Oxy have provided gains to my portfolio. It wasn't as if I was in a negative position. They have provided gains, so I thought, okay, you know what? I don't see this recovering for a while, especially Oxy, unless Buffett takes it out, which he said before he has no interest in owning the whole thing, but he just keeps buying, so I don't know where he's going with that. He can, I think, buy up to 50%. He's at 28%. I just find that going into 2025, in this last quarter, and what I see happening in 2025, these aren't going to fit very well with the pivot in the strategy that I'm using for 2025. These just aren't going to work very well. It's every so often you have to change what you're doing. From 2010 to 2020, REITs, and I killed in REITs. REITs, if you look at REITs, they outperformed the S&P over that 10-year period. REITs outperformed. It was just like shooting fish in a barrel with REITs. It was just easy to make money with REITs during that period. Then it got hard, and now it's you gotta be tactical. But I can still do it with apartment REITs. But I'm out of every other kind of REIT mostly. But apartment REITs, I have no U.S. REIT exposure, only Canadian REIT exposure. But it's time to shift. I thought, well, I'll shift out of REITs into the more industrial part of the economy because infrastructure rebuilding, India building out, it just seemed to make a lot of sense to be there. But I'm seeing that it's probably not going to be the biggest payer over the next 2 years. I'll give you a peek ahead into what I think 2025, the major thing of 2025 is going to be. For the last couple of years, it's been return. Almost no volatility. It's been return. I think that goes away. I think the king in 2025 is going to be volatility. That is going to be the theme. What direction are we going? I don't really know. But I do know we're going to have increased volatility. Well, I don't know. I suspect quite highly that will be the theme of 2025 is volatility. Is it because you're trying to free up margin for IBIT MSTR trade? No, I got plenty of margin for that. Do you think 2% real yield is restrictive? Or why do you think 2% real yield is restrictive? If we look at where real yields have been in the last 15 years or so, 2% is rather elevated for the real yield. And the Fed does say they are in restrictive territory at this point in time. Inflation target, I believe, set at the Fed at 2%. PCE comes in an annualized 2% or around that. Wouldn't that mean that the Fed would not lower rates, anything else being equal? So your argument here is that if their target is 2% and it's at 2%, why do anything? Because they do admit they are restrictive at these levels, that they are above the neutral rate, that they are restrictive. So if they are at target on their inflation level, having an interest rate this high, it is believed, would be holding back growth. If we look at the Taylor rule, the rate, this is a nominal effective federal funds rate, is equal to some real neutral rate plus your expected inflation, which we'll call 2% as the target. So you have some neutral rate, and the question is, well, what is it? Now, some people, when they talk about the neutral rate, they combine the two of these together and they come up with a RN star, a nominal neutral rate. And then you have your your economic trade-off, right? You have growth and you have inflation. And in the literature, inflation is always pi. Expected inflation is pi to the power e. So growth is half the story, inflation is the other half of the story, and you look at the growth that you currently have minus the potential growth to figure out, are we below trend or above trend? And we look at the inflation that we currently have versus the inflation target that we have set to figure out if inflation is below or above. If you're at target over here and you're above trend over here, then this is saying that you should be raising this interest rate if you're above trend. If you're at trend and you're at target, you should do nothing. Some thinking is of the lines of, well, no, it may be not interpreted that way, that if you're at trend over here, then don't worry about what's going on over here. If it's not inflationary here, you can lower rates to increase what is going on with GDP now. Maybe higher rates are holding back the economy, that you could run over the economy's capacity without following the Taylor rule of having to raise rates because of that. You could say, as long as this is well behaved and anchored over here, we can go ahead and continue to lower rates because maybe we're wrong on potential. Because potential is theoretical, much like the neutral rate is theoretical. So if you have an economy running at 3% real growth and you think your potential is 2% real growth, but it's not causing any inflation, chances are you're probably wrong on your economy's potential growth. Not so much saying, well, we better raise rates to slow the economy down. Not if it's inflationary. So if you are at target, why lower the rate? Thinking is we're probably not seeing the real growth rate we could have if we had lower rates, as long as inflation is not the enemy. As we step into 2025, I'd like to suggest something for your consideration. Reintroduce the corporate OAS credit spreads for investment grade versus high yield. We had that in there for a while, and God, like watching paint dry, nothing to see week after week. Super tight spreads and nothing to see. No matter what happened that week, the spreads just kept saying, we don't care. Reflecting on the start of 2024, market anticipated that spreads would widen due to corporate loan rollovers and highly restrictive monetary policy. However, this expectation did not materialize, or hasn't yet. With the yield curve now steepening and the 10-year exceeding 4.5, it could be insightful to revisit corporate spreads. I can throw the corporate spreads back on there, but I don't see how the 10-year rising would cause corporate spreads to widen. Because, corporate yields would increase with the yield in the 10-year, but the spread may stay the same. So you could have a corporate yield that is made up of a risk-free component and your credit spread. And this whole thing is the yield, and the risk-free rate could increase, thereby increasing the yield. But there's nothing saying the credit spread would have to increase, just that the risk-free rate would make up a bigger proportion of the yield. In fact, you could even have corporate spreads decreasing. If you have a good, solid economy with the risk-free component increasing, you could still have spread contraction. So I'm not sure, just because the risk-free portion of the yield is increasing does not imply that the credit spread would increase. The credit spread is going to be related to the risk of not getting paid back, which will be a function of economic growth more than anything else. TLT, is there a price point that it could get down to where you go all in? No, I think I have my allocation to fixed income at this point in time. I think I'm good with that. Like taking a final stand. No, not really. I'm good. I've recently transformed a part of my cash flow stream into a short-term private credit note, which gives me more exposure to debt than I currently have right now. So I'm good. I think I'm all in on where I want to be. Now, that doesn't mean that I won't use the options on TLT, selling a put here or there, selling some calls. I will continue to do that. That's all part of risk management and income enhancement. So I'll continue to do that, but I'm good where I am right now. As far as any bets on fixed income, I think ZQ is the biggest bets that I would be making. I'd be betting directly on the Fed funds rate, more so now. Any thoughts on the neutral rate debate? Do you think it's possible to have 4% in the long run as the new regime, as many talked on Bloomberg? If that is the case, does that mean the 10-year will stay at 4s or even 5s? So the neutral rate, I don't think is a fixed point. I think it depends on how you're getting that growth. So if you say, well, we have 2% long-term real GDP growth, and we have 2% inflation. If you're achieving this with fiscal deficits, you might have a different type of neutral rate than if you were achieving that with domestic demand on its own with a balanced budget, right? So I'd have to put a conditional in there saying, well, how are you achieving the growth, with a balanced budget or with a fiscal deficit? Because that may change the nature of the neutral rate depending on how that money is being transferred to the private sector. It also depends on the level of technology to say, that the neutral rate is X or Y. If you have, then it's hard to measure. The labor force is easy to measure, right? So our potential GDP growth is a quantity or a function of the labor force and of the productivity of that labor force. So if you have two people and you have a third potential laborer, you have a potential 50% growth in the labor force, which means if you have three people working instead of two, you should be able to produce 50% more output. But if each person can produce 10% more output, you'd produce even more than 50%. So it's a function of these two. Well, headcount is a fairly straightforward thing to do. What is more difficult to do is the quality of the labor, right? Is the labor force improving in its quality or decreasing in its quality? Because if I have a high quality laborer and a low quality laborer with the same technology, the high quality laborer will have higher productivity even though they have the same productive technology, the same productive capital. That's harder to measure. Same with labor productivity, because labor productivity is more of a result than a summation of things. You can look at the type of capital that we're getting, or that is being added, and it all just relies on assumptions and estimates when you get to labor productivity, because it's hard to actually measure. So you could be wrong on your forecast of what potential is. And I think that is the problem right now. If you look at the summary of economic projections, you get to 1.8% long-term real GDP growth. With technology where it is, I think the potential GDP is significantly higher, but I also believe that it's very unlikely that you're going to reach the potential. But I believe potential GDP is way higher than 1.8% real. That the U.S. economy has the potential to produce a hell of a lot more than that if it employed all its labor and all its capital. It has the potential to be higher than that, but very unlikely it's ever going to get to that point. And if it's very unlikely that you're ever going to get to the point of potential GDP, why are we worried about inflation? That's why I say we have a backdrop of deflation. So if this were the case, we think about instead of 1.8, imagine it were a 5% real, that you have the potential for 5%, and you're running at 3%, and you think, oh, we can get to 3.5. That's still not inflationary at all. So I think if you're looking for a neutral rate, it is significantly higher than where it is now. Significantly higher. However, You'll never get to that point because the real economy can never get to that point before the deflation shows up. Which means, even though the real rate, if we're thinking where the neutral rate would be in relation to the potential GDP, since the economy will probably never hit its potential, inflation will be the bigger dictator. The inflation rate will be the bigger dictator of where the neutral rate will be. And if you do have potential at 5 and actual at 3, you have behind there a deflationary environment, which means the neutral rate is probably 0, maybe even negative, if you think about it that way. Now you're thinking, well, how can an economy have more potential than you can actually produce? Let me put it to you like this. Here is iTunes, right? And here is a song that you want. What is the limit? What is the supply of that song? What is the supply? There is no supply. 1 million? What if there were 2 million downloads? Would you run out of the song? What if there were 10 million downloads? Would you run out of the song? What if there were 100 million downloads? Would you run out of the song? No. There is no capacity limit on digital activity. So what is the capacity of the economy when you consider that the digital world is becoming a bigger and bigger part of everyone's life? What is the capacity? Significantly higher than 1.8% real, but in a way that you'd never actually hit that capacity anymore. So if actual output can never get near potential output, where's the inflation? The only way you get inflation is to cut off supply somehow. Is to say, sorry, for this song, there can only be 100,000 downloads. And there'll be a marketplace for this song where there's a bid and an ask. And of these 100,000, that's all there will ever be. And this song is tracked on a blockchain so that ownership is to one person. So you can't just make copies forever and ever and ever. There can only be 100,000. Well, then the price would go straight up. There's your inflation. Only if you limit supply will you get inflation. But in an economy that attempts to not limit supply in the digital world, for the most part, for products or services, the neutral rate, 0, because the neutral rate is not going to matter about where potential GDP is anymore. It's only going to matter where the level of inflation is. if you follow that logic. 2025 theme video, wondering if you're going to dabble in a new poetry for us this year. Yeah, New Year's Day, we'll put a new poem up. I'm debating between, I got about 3 or 4 that I'm looking at now, thinking, some of them are just too simple. They don't have enough deep thought in them, but I don't want to keep going back to Robert Frost, even though I think he has the best ones. I want to try to explore a little bit, but something that captures the human condition, not just, there was a woman from Nantucket who happened to say, I gotta want something stupid like that. Whether you can do an AS, Applied Series video for top-down, on fiscal policy deficit and how it affects markets in general. Yeah, you haven't done that, right? We haven't done the fiscal, which is the other side of Keynesianism. You have monetary and you have the fiscal. I haven't really done the fiscal. I guess I could do it without getting into a philosophy discussion about what I believe a government should be doing. Just if it is doing this is the effect it has. The U.S. is different, though, because it has a reserve currency, right? The U.S. is different than other countries. I guess I could do something there. I don't know when, but I guess I could. Forward PEs have persistently been above its long-term equilibrium around 16. Do you see there's been a regime shift where we'll continue to see higher forward PEs? You could always make the case that there has. I think a more interesting argument would be what would cause it to return to 16, right? And you think of events that would cause this to happen, and how likely are those events, or how plausible are those events? is there something? You can say yes. Just the changing mix of the nature of the companies in the index, because the index does rebalance. That if you're going to put more technology and growth stocks in the S&P, especially companies that have big network effects, yeah, you're basically changing the composition of the index significantly over time. You can make that argument. You can also make the argument that, well, what is new today will be mainstream tomorrow. What is growth today will be value tomorrow. That the index over time will have an attractor point, because as companies age, their growth slows down. As we progress through technology, what was a growth technology today will be a value technology tomorrow. Right? And all companies go through these cycles. That if the S&P is a broad reflection of the economy, it should be a broad reflection of value and growth. And those growthy companies will turn to value. The question is, will they be replaced by growthier companies, or will that growth tend to subside going forward? Will growth get more competitive going forward? That might return it back to its historical range. If it is, if the S&P 500 is a reflection of the economy, then unless you think the economy has changed, why would the S&P 500 change? Unless you think, that this is just some kind of post-pandemic adjustment that needs to be done until we figure out what the hell it is. Yeah, you can make the case either way. What are your thoughts on the recent strengthening of the US dollar? I've already answered one of those. How can this impact global liquidity going into 2025 given foreign US dollar denominated debt is at all-time highs? That is a problem. Yeah, that is a problem. Oops, wrong side here. Why is a 20-year Treasury bond higher than that on a 30-year? Clientele effect. 30-year has a clientele effect. There are certain buyers of the 30-year, and there are buyers of the 10-year. But the 20 years, the 20 years not the 10, too much duration. But it's not the 30, not enough duration. The 20 is kind of sitting in the middle of it, saying, "What about me?" And if I'm looking for duration, I may as well buy the 30-year. If I'm looking for risk management, I may as well buy the most liquid, which is the 10-year. The 20-year is, it just doesn't have a clientele effect. So it does have an extra yield to it, which is interesting. Why it continues to exist is also an interesting thing, but there it is. Difference between long-term neutral rate and short-term neutral rate that we need to be aware of. Well, the neutral rate is only a topic of consider. If you had inflation at 2% and it never changed, and every month we got the reading in, and for the last 5 years, 2%, 2%, 2%, nothing to see here, folks, 2%, 2%. What would be the neutral rate? It would be anything you want it to be at that point. Could it be higher? Could it be lower? Who the hell knows, right? So at that point, you wouldn't even be talking about the neutral rate. You only talk about the neutral rate when there's inflation. But as I've already said, I do think that what is off is our guess of potential GDP. And I think we operate well below our potential, which would be a deflationary backdrop. But do I think that there's a short term and a long term? Yeah, because there are fluctuations. So I think the interest rate at some times, that the economy would be more sensitive to an interest rate at some times versus other times. But it is an unobservable point, and it is a theoretical point, and I don't think it's a point. I think it's a level in relation to something else. So that means that it's not a fixed point. If we think long-term GDP growth will be 2%, long-term target inflation is 2%, wouldn't that make long-term neutral rate 4%? Well, you start the sentence with the largest word in the English language, if. If. So those are your assumptions. If we think long-term growth is 2%, and if long-term target inflation is 2%. And the neutral rate is proportional to those two, but not necessarily the sum of those two, but proportional to those two, meaning that if we thought interest rates, or that the long-term growth rate were higher with 2%, that would imply that you could have a higher neutral rate. A neutral rate doesn't necessarily mean that's where you want your interest rate to be. A neutral rate simply means that is the interest rate which would neither decelerate or accelerate either the economy or inflation. It is neutral. It would neither do anything. But what if you want to accelerate the economy because inflation is too low? What if you want to decelerate the economy because you're fearing inflation may get too high? Right? So the neutral rate is sort of like a fulcrum where you can balance two things, growth and inflation. And neither one of them, they're both in equal opposition. Neither one of them are going to move. You have something neutral. But that doesn't mean you want something neutral, right? I think the focus is too much on where's the neutral rate. Let's get to the neutral rate. Don't we want economic growth? So if we don't have an inflation problem, why stay neutral? Why not lean into it? You know, think about it as a fund manager. What is your neutral position? To be an index fund. But what if you want to beat the index? Do we have to stay neutral? It's easy to find the neutral point, but I don't want to be neutral. I want to be active. So the interest rate can have an active position versus the neutral rate. And who cares what the neutral rate is? I think all we really have to care about is where's inflation? If inflation is below target, that's all that really matters. Is, well, why wouldn't we be active on the interest rate to pursue higher growth and outperform? If the constraint, which is inflation, is not constraining us. I'm curious why you no longer show break-evens. It just got boring. There was nothing there to see week after week after week. It was like the break-evens would move a little this way, move a little that way, move a little this way, move a little that way. Like the OAS is like there was just nothing to see. There was really nothing to see anymore. Suppose I subscribe before January 15. Sector studies will have access to further updates for sector studies. Yeah, if it's just the sector studies module. Yeah. Oops, I'm still on the wrong side here. There we go. One of the position videos last week, you mentioned that you exited FCX. Would you be able to tell us more about this movement in your position video of the week coming up? Yeah, I can explain why I exited those. Curious to see if you still see copper as a good thesis. Yes, I do. But I have said this before. Short term, we have no supply. Long term, short term, we have no supply issue. Long term, we do. Long term, we do. So it is going to be a deal. A big deal later on. Long term, we do. But for the next couple of quarters, I just don't see 15 or 20% upside or 30% upside to these. But I do see other things that have upside. Any comments on Lennar spinning off its land holdings? Should increase ROE and gross margins. ROE is... Yeah. I imagine they wouldn't be doing it if it wouldn't have some benefit. So what's going on is, let's take their balance sheet, assets and liabilities. They have some land here, and they have cash. What they're going to do is take about 5 or 6 billion of this stuff and 1 billion in cash, and wrap it up in a new REIT that will be involved in land acquisition and development, and then selling it back once they're done selling it back to Lennar. Not only that, but selling it off to other home builders as well. And they're going to issue shares to the current shareholders for this. They're just spinning it out, so it doesn't actually raise any cash. So I'm going to make some numbers up here, so don't say, oh, that's not the price. Those aren't the numbers. I'm just making it up to show you an example out of thin air. Let's say Lennar's 140, and they spin this out, and it will be a $20 stock, let's say, in terms, and that proportional to its market cap. Lennar would then drop to 120, and you'd be holding shares worth 20 equaling 140. So you'd still have Lennar, but now you'd have this REIT, and you'd have to ask yourself, do you want to continue to hold on to the REIT? Or sell it off and take the cash for it, because you will end up with shares of that, and 80% of the shares will be distributed, and 20% will be kept, and that would probably be classified as investment in associate, because it's the 20% level. That would give them ownership but not influence, so that would be an investment in associates. Depending on the valuation that goes out at, it might not result in any change in the asset value on the balance sheet. If it doesn't result in any change on the balance sheet, its return on assets would be the same. Hard to tell because they're not selling it and getting cash, right? They're spinning it out but retaining 20% of the ownership. Some assets are going to leave the balance sheet, and then they just create, they're not selling these shares, they're just giving these shares to shareholders. It will lower the equity in Lennar, and if we think that, well, this is what's been holding it back, then we should have a higher ROE. But is moving from an asset heavy to an asset light balance sheet, I guess with interest rates where they are right now, if you expect interest rates to be high, why would you want an asset heavy balance sheet? So it would have some effect. Yeah. I don't know if it operationally would be better. I don't know if it operationally is going to increase gross margins, but it certainly will reduce interest expenses. If we think that they're going to pay down the debt somehow, but keep in mind, this involves no cash. Right? They're not selling anything. It involves no cash. So even though they get rid of that, it may reduce the need for financing in the future, but it may not. It probably wouldn't have any effect on the debt today. Advocating for copper. Already talked about that. Thoughts on office REITs? I wouldn't touch office REITs. It's just not something that I'd be interested in at this point. I don't think work from home is really a thing, but this is my thinking, is that you've always had work from home, even before the pandemic, and you had a move to the digital world that was happening at a certain pace, and then the pandemic hit, and I think what the pandemic did for this move to a more digital world is it changed the slope of this trajectory and increased the pace of it. And increasing the pace of it has, given us more things that can be done from a distance, or more things that could be done remotely and measured. So I think this, even if you had a return to office, I don't think you'd have the same number of people going back. I just wouldn't touch office space right now. Hearing from CRE executive of private real estate firms in Canada that they're getting bullish on office. Oh, look at that. They are biased. It's their, well, okay, there you go. Lower rates could decrease the cap rate. My opinion is that if the recession hits, it will be the catalyst to have firms push office mandates more aggressively. Recessions would hit net rental growth and could lower demand. Yeah, there's your trade-off, right? Feels like a contrarian play in the next few months. I would guess my question is, what is your view on them, and how would you approach the thinking on this? I wouldn't. They're just easier fights to win. I just wouldn't be interested in office REITs at this point. And if I were, it would be the best of the best. That would be Boston Properties, trophy buildings that pretty much will always be full. But beyond that, I wouldn't speculate on office REITs at all. Not one bit. I think the work from home is a bigger cohort and will always be a cohort. I think there is a spot for work from home, especially for work that can be measured, output that can be measured. Customer service is something you can have done from at home because you can measure the throughput of the emails that are solved that day or the case numbers that are solved that day. What was your case number count? So you get an email into customer service and it creates a case number. And so you have all these case numbers build up and you can have people all over the world taking care of this, and you can measure how many cases were taken care of. And once the case is resolved, you send an email to the client saying, rate this, right? So you combine the rating that you have with the number of cases that you solved that day. And if you are solving over a certain minimum threshold and maintaining a certain minimum rating, that's what I would expect if you were in the office anyway. So what do I care if you're in the office? I can measure your output. But if you're on the marketing team, I'm sorry, you got to be on site, because a lot of the creativity is serendipitous. It is me building off you, building off the other person. It is conversations in the hallway. It is me popping into your office saying, "What do you think about this?" It is us drawing things out on a whiteboard. You need the environment, because the environment has a certain amount of synergy in it. So one person working at home and one person working at home will give you two people working for you. But combine them together and the proximity creates something that you can't create from a distance. So 1 + 1 equals something more than 2 when you're in the office. And I think from a financial point of view for companies, I think there is something to be said from embracing work from home for jobs that can be measured, is saying, I have an office and you have a home. You can choose to stay at home, but there is a premium to being in the office. I'm willing to pay a premium if you're going to be in the office. If you're not, well, then you are going to make less than the person coming in, because I'm willing to pay a premium. Another way of saying that is, if you're working from home, I'm paying you a discount. So it would be cheaper if you're working from home and I can measure output. Done, right? That's nice and simple. Also, you are non-promotable when you work from home. I don't have to tell you that, but you're non-promotable. If you're going to be promotable, you're going to be in the office. I'll pay you a premium and you're promotable. Those are the benefits of being in the office. What are the downside? Well, that you got to travel to the office. Every advantage has a disadvantage. That's the trade-off of life. There's never anything that has pure advantages. So I think there'll be a growing ability to get this done, especially as you can start to measure better the type of outputs that are produced. So customer service is an easy one to figure out how to measure that one, right? And as you can begin to measure the output of other jobs, it does enable work from home a little bit more. I'm not entirely against work from home for certain jobs that can be measured, but work from home generally has been lower productivity. This has been corroborated by quite a few academic studies already, that work from home is lower productivity, which means higher cost for businesses with work from home. But I still wouldn't make a bet on office REITs on return to work or return to office mandates. I wouldn't do that. Understand the change to applied level. Does this mean by buying the applied level for 440 before January 15th, I guess, regular positions? Yep. Yes, you do. You get everything and no recurring fee. As of the 15th, I do have to change it. That was part of the strategy in setting up, right? You need to create a network effect, which means you need a critical mass of users. Such that when somebody says applied level, somebody else goes, I heard of that, because there's enough people that talk about it. Once you get to a certain level, you have to say, okay, we've got the network, we've got that done. Now it's got to be priced as it's used. And if you keep adding users at one fee, but going forward, there's streaming and email notifications and streaming and answering questions and email notifications. Your costs continue to increase in proportion to the size of the users. How do you fund that ongoing cost? Once you have a critical mass of content, you say, okay, well, the content has value. Content has value now. Now it's time to have the pricing reflect that value. In any product launch, your early users get a good deal because any company is willing to give its early users a really good deal to get the product out there and to get feedback so that it can start iterating on how to develop it. Where do I go? What do I lean into? What do I add? What content did they like? What content didn't they like? And then after a certain while, when you get that product stabilized, you say, okay, now we're ready for the real market. And that is what is going to happen on January 15th is the real market. Anybody in by there got a good deal. And then, not that you're not going to get a good deal after the fact. You got a great deal if you got in before because then you only pay one fee. After, the pricing has to reflect the fact that this has ongoing costs to do. Every company launches product like that. What software to use for screen recording and writing? So what I'm writing on over here, this thing here is called Sketchbook. And it is on Apple, the App Store. Well, of course it's on the App Store. There's a free version, which isn't very good, and then the paid version. This is the paid version. It's only like, I think it was like $30, 25 or $30. And then to record the screen, I use something from Telestream. That is a company that has a whole bunch of products. I use something from Telestream called, what's it called? Screencast. No, not Screencast. Hang on. What is it called? ScreenFlow. ScreenFlow. Let me write that down for you. ScreenFlow for Mac. Now, there are better screencasting things out there. It's just this one is inexpensive and it does the job. I think it was $200 and it does the job. And then I use a Cintiq, C-I-N-T-I-Q 13D, which is the tablet I write on. I use the 13 because it actually has a screen. It's not just a square tablet that you try to guess where your pen is on the screen. It actually has a screen that you can look at and see. And then I use a microphone, which is a blue Yeti. Right? I do have the Yeti, and then I have the blue. It's called a Blue Snowball. Sorry, not Blue Yeti. Blue Snowball. And I do have the Yeti, which is the higher end one. But if your computer, there's a desk, and if your computer is sitting on a desk, and your microphone, your Yeti, is sitting on the desk, your computer has a vibration which will travel through the desk, and your microphone will pick up this hum in behind. The Yeti is super, super sensitive, which means you're going to have to get a stand like that and hang your microphone from the stand and have it off the desk. Otherwise, that Yeti is going to pick up every vibration off of your desk. And if you don't think there's a vibration from your computer to your desk, put your ear to your desk and just listen to what you hear. You will hear the computer. Even if you can't hear your computer, like I'm sitting here, I cannot hear my computer running. The microphone's not picking anything up. But if I put my ear to my desk, I hear it all. And that is what the Yeti picks up. So you got to be careful there. You need more room to get this hanging microphone so that a really good microphone should not be touching your desk. Any thoughts on Novo Nordisk after its slightly disappointing trial release? Well, slightly, that's the key word there. It was slightly disappointing. Trying to remember all the details on it. I think phase 3, and I can't remember the names of these things. I know its biggest competitor is Eli Lilly. I don't know I forget the names of what they have. I think it's Ozempic. Ozempic. And they have another one. I forget the name of it. And then Novo Nordisk has this one here. And on phase 3, it came in at, I think, 22.7% weight loss versus Eli Lilly at 25% on theirs. They were all on the limited supply list in the U.S. that we have it if we have it. But Eli Lilly is now off that list because their supply can meet whatever demand there is. So if you go to the pharmacy and Novo Nordisk is still on the restricted supply list, restricted meaning that they don't have enough supply all the time. You go into the pharmacy and the pharmacist says, well, you can have this one which has 25% weight loss after 68 weeks and we have supply, or you can have this one which has 22.7%, but we're not sure if we have any in stock right now. Well, I mean, which one are you going to take, right? So it is efficacy along with supply. Now, if everything had a supply shortage, it's you go into the drugstore, you say, well, I'll take whatever you have. 22.7, 25, doesn't really matter. I'll take what you got. But if you have a choice, aren't you going to take the 25, right? So when you think about 22.7 versus 25, unless you're going to price it significantly lower, that is a problem. Do you see long-term value in U.S. healthcare space more broadly? Well, it is. The U.S. does have probably the most unhealthy population. They spend the most per capita on healthcare with some of the worst outcomes. So I don't know. Do you see long-term potential in a very sick population? Probably. But at some point, you got to start figuring out how do we pay for this stuff. Now, if you change the inputs, and I think a big part of the inputs in the U.S. is the food supply. If you change the inputs and you change regulation around food, you increase the threshold for what can be called food. Maybe you can create a healthier population if you start squeezing the amount of sugar out of the food supply. Just the sugar alone, if you start squeezing that out, if you end up with a healthier population, then all that healthcare spending goes down, right? It's healthcare is one space where I don't really understand the biology of it. I can't assess it because I don't understand it, and I don't want to do a deep dive in biology textbooks to figure it out. I'm just not interested. So I tend to avoid those spaces because I'm not a doctor. I don't understand the potential of any of this stuff. I'm probably the last person to ask on that. U.S. is poised for another debt ceiling fight. 2025 temporary suspension ends on January 1st, forcing lawmakers to once again confront the possibility of default. Again and again and again, right? House Speaker Mike Johnson's approach of pairing any debt limit increase with major cuts to programs like Medicare, Social Security, supported by Trump, sets the stage for a contentious battle. Is Speaker Mike Johnson the important one there, or should we say Elon Musk? It's what Elon Musk wants, right? And that's starting to wear thin with Trump. I think the easiest way to get rid of Elon Musk is to keep calling Trump Musk's vice president and to keep calling Trump president. Trump does not share the stage. And even in a joke, he's not going to find that funny at all. And he will remove the source of that very quickly to show that he has the power. If you don't want Elon Musk in government, keep calling Trump Musk's vice president. You know, Trump is waiting for Musk to tell him what to do. Say things like that. That relationship will end very quickly, very quickly. But I don't know that so much it's about Mike Johnson here. The Treasury's use of extraordinary measures might buy only a few additional months. We always get here. We always get here, and it's always solved. It's the drama. It's the cameras. You know, because you're campaigning at the same time. Is you're not going to let a crisis go by without campaigning, and you're not going to waste a crisis. It's about getting on camera. It's about saying things that so you can run it in your re-election campaign, saying, "Oh, I stood up to this. I fought for this." Unless, of course, that's not what you want, then you don't put it on camera. But you try to get us on camera as many times as you can, showing that you're fighting for the American people, no matter what it is that you're going to do, knowing that you're going to vote for whatever shit thing they put through in the end. But, of course, you got to campaign to the last minute, right? Why wouldn't you? That's politics. So this is all show. It's a dog and pony show each and every time. Does anybody think any of these people are serious about not about not doing anything. I just don't see it. How might the Trump administration's promised spending cuts combined with renewed debt limit battle influence government bond yields? Ah, wow. That's a big one, right? That's what everyone's trying to figure out. Right now, the market is saying, nope, it's going to be negative. TLT at 80, 87 for most of the morning on Tuesday morning, the 24th. The market believes it's not going to be helpful or useful, even negative. I don't really know. The debt limit debate thing, I don't see it as interesting. How many times have we done this in the last 20 years? Right? It's not interesting. It's show. It's a political show. It's for the cameras. It's for re-election campaigns. It's for snippets of, some kind of video for their next commercial. That's really all it is. It's just a dog and pony show. I think it's going to be, what are the spending cuts? What is going to be the deficit to GDP? And I think it ends there. You're not going to get real tax discussion for at least a year. There's way too much to do in the beginning. That if he does everything he says he's going to do on day one's going to have to be 6 weeks long, just to sign all the executive orders that are probably already written. Let's see. I already answered this one. Any of you comment on The Creature from Jekyll Island by Edward Griffin? Not really. This is a sort of an anti-Fed theme, I think. So not really. My payment was processed. Okay. We know Trump will take office January 20th. In less than a week, there will be FOMC meeting. Do you think markets will continue to drift in their current direction until the first volatile week of the new presidency? Or volatility will show up before it all begins? Volatility is showing up now. And what is the latest thing? I want Panama Canal. I want Greenland. And then the next day, what's the next thing? Greenland's not such a bad idea. That stuff's going to get mainstream. You're going to have congressmen and senators saying, Greenland makes a lot of sense, and we should have the Panama Canal. I want you to think of the words manifest destiny. I don't think it's enough in Trump's mind to be the king of the USA. I say king because I don't think he sees himself as governing. I think he sees himself as ruling. He thinks of himself as a ruler, not governing, but ruling. Those are two different words. I don't think it's enough for him to be the king of the U.S. I think he wants to be the king of the world. But he's got to see, well, where will people shut me down? I'll make fun of Canada as being the 51st state, and that conversation will get a life of its own. And it'll start to make sense. And maybe even in Canada, some people will be saying, yeah, we should be the 51st state. Let me float this thing about Greenland. Let me float this thing about the Panama Canal. There was a guy in Europe some 70 years ago who said this thing about Czechoslovakia. Hey, this area of Czechoslovakia should be ours. And then he eventually took it and nothing happened. So then he realized that I could grab something else. And he did, and nothing happened. Then he said, I could probably grab something else. And he kept going and going and going. And pretty soon it started a war. Forget that fella's name. Didn't end well for him. But does anybody see shades of manifest destiny showing up in Trump? That he wants every other leader in the world to bow down to him, to say yes sir, no sir. He wants to tell them what they're going to do, and they report back to him. I don't think he sees them as sovereign nations. I think he sees the U.S. As the only nation, and I think he sees himself as the king of the world, and he wants to be the king of the world, and he will act as if he's the king of the world. Expect more volatility, because what's he going to say tomorrow? On day one, I'm going to instruct the army to position itself along the Canadian border. That's a prelude to an invasion. I mean, is he going to say shit like that? If he says it, would anybody be surprised? Would anyone be surprised? He's not a calming force at all. So I think you've already got the volatility started, and as things get closer, that volatility will probably increase. And as you start to see what he's actually going to do and realize that, well, he's the same guy He's got policy and he's got punishment, and he doesn't care what the fallout of the punishment is. It's for his ego. I think we'll start to see the volatility. That doesn't mean markets can't go up, but I think that volatility is going to be a big deal. Yield curve has come out of inversion. Historically, a market crash always followed. I don't know if I'd call it a market crash always followed. But certainly negative returns. We can say negative returns. Are you still bullish for 2025? Certain things, sure. I'm bullish on volatility for 2025. I've said that a couple of times. I'm still bullish duration for 2025 because this can only end one way, and it can only end badly. I just don't know when it ends, but it can only end one way. I think we do have a deflationary backdrop, and I think Trump is underestimating how much resistance he's going to get from the rest of the world. At some point, he will go too far in one of his statements, and all he will do is unify the opposition against him. He'll unify against him. He won't have everyone fall in line quietly and separately. It'll just be a unification. It'll either really work out, or it will just be absolutely horrific for the U.S. I don't see a middle ground because he's not a diplomat. Unemployment has also been rising quite steeply in the past months. I don't know if I'd say that is steeply, but market crash, you got to give me a catalyst. What's going to cause it? It's very rare that just the fatigue of an economy causes it to break. Usually something external happens or something big inside blows up. What would it be? Give me the catalyst. I don't have one. You have a good following. It would be great to interview some of the other financial talking heads. I don't really want to do that. I've been asked by other channels to do an interview, and I've always rejected that. And it's just not my thing. There are other people who want to do the YouTube tour and do that kind of thing. It's just not my thing, and I don't want to be in that circle. I don't want to do that. It's not my thing. That's not saying that I wouldn't interview people. I just don't see the point of interviewing the YouTube talking heads because you can find them everywhere. What would they say that would be any different? Everyone's giving everyone else exposure. That's all it's about is giving exposure. Would I interview somebody? Yeah, but it would have to be somebody who is important or significant enough, or who is interesting enough, not just another talking head. The Compound does a good job of this. Josh Brown, they have some interesting people on when they don't have the technical analysts on. They tend to have a lot of people who want to show you a lot of charts, and they draw lines on charts, and I think that's just ridiculous. I don't listen to any of that stuff. But they do have good people on there. I said I like Cliff Asness. I sort of follow him around wherever he is and listen to his. The Compound did a great interview with Cliff Asness. I recommend listening to that. But Josh Brown's really good at interviewing, and he already has good people that are on. I don't know that I could do better than that, but if I did do something, it would be along those lines of interviewing people like that, not your regular YouTube talking heads, because you can find them everywhere, and they want to be everywhere. They want that exposure, so they can have it. If I went on a show, I'd just be taking exposure away from them, and I don't want to do that. I don't want to be. That's not my thing. Read many 2025 outlook reports. Many institutions have the right questions asked for coming years. Investment opportunities would be amazing. You could do a 2025 outlook live session. Give us your thoughts about the market, life, and what plans you have for the Meldrum community in the coming year. The first live session is going to be the first Sunday of the year. Where is my iPad? I'll just tell you what the first Sunday of the year is. Let's have a look here. Calendar. Let's see. Going into January of 2025. You got to scroll right up to get there. The first Sunday is January 5th. That'll be the next live event I do will be January 5th. But this Sunday coming up, I'll have some 2025 themes. I don't know about forecasts, but themes that I think will be important for 2025. LSG is pronounced L-SEG. I'm just going to leave the dash out. I'll pronounce it LSEG instead of L-SEG. I know what you're saying. You're probably saying, that's not what I meant. You're saying LSEG. I guess it's easier than saying LSEG, LSEG. Second request I had was hoping you could address in some way to respond to The Great Taking by David Rogers. Again, that's another, scare you into something else kind of book. Look, the two that you're the same person that's saying the same thing. You've mentioned the other book as well. It is easy to take any institution in a complex system and scare the shit out of you with all the disadvantages and all the bad stuff. I could do that with the fire department. I could do that with the police department. I could do that with the army. I could do that with any politician, any secretary position, any minister position. I could do that with the institution of marriage. I could do it with anything. I could do it with religion. I could do it with education. You can take the disadvantages and the negative parts of almost anything and write a book about it, how absolutely terrible it is. Misses the point. In any complex system, you don't have maximization, you have optimization, which means you have trade-offs. You always have trade-offs. Everything will have disadvantages. Everything will have disadvantages and advantages. So listing the disadvantages, so what? You have to balance it with, well, what are the advantages, right? And are we talking about the greatest good for the greatest number? And if we are, there it is. Does that mean everybody wins? No. Does that mean there will be losers? Yeah. Does that mean there'll be disadvantages? Yeah. But the system isn't in place because of its disadvantages. It's there because of its advantages. It's there in spite of its disadvantages. It's easy to go down these rabbit holes of these books that tell you how bad something is and how it destroys this and how it destroys that. Yet here we are, living in a society with the greatest accumulation of wealth in the history of the world, with the greatest progress of technology in the history of the world, and we're shitting all over what? The disadvantages? I think the advantages of our system has far outweighed the disadvantages of our system, right? But nobody wants to read a book of good news. It doesn't sell. Bad news sells. Bad news sells. Scaring the crap out of people sells. But it's too easy to do. It's too easy to do. What is your opinion of real estate as an asset class and diversified, long only, always invested, period? Oh, that's a lot of modifiers here. It's like I'll have a steak, medium rare, with 10 modifiers. Waiters love that. As an asset class, a diversified, long only, always invested, periodically rebalancing portfolio. I've been researching the asset class and actually takes a very high correlation with S&P 500, trying to determine whether real estate would be function as a true diversifier or just another expression of the same trade. Okay, so I guess a better way to think about it is, well, what role do you expect it to play in the portfolio? Do you want it? Are you selecting real estate because you want it to be a diversifier? Then you could look at it on its correlation with the S&P, and it does have a beta correlation. It does a beta component, so it is going to have a correlation. I would think that you would look at real estate as an income component of a portfolio and less of a diversifier, but more of an income component, because you can have a number of asset classes in your portfolio that perform certain things, right? You can have saying, well, I want growth. Somebody else says, well, I want safety. Somebody may say, well, I want income. Well, what is the mandate of your portfolio? All right, is it growth? Then you probably don't want real estate. But if you take your portfolio, say, well, you know what? I think 60% growth. But let's not be crazy here. Let's make sure that we're diversified somewhat. Let's get something for safety and something for income. that you might say, well, my growth component would be SPY and maybe a blend of QQQ, and then maybe a few other ETFs that track more higher beta sectors. Your income, you might say, well, here's a good place to put some REITs because they have a nice high dividend. There's my income, which will build up my cash component over time. So my cash component will get bigger so that when this pulls back, I can deploy the cash because growth doesn't really have a high yield. Then you have safety. Here you would have some corporate bonds and some, let's say investment grade. So you always have something to fall back on. That if suddenly conditions in your life change and you say, okay, I need to come up with $100,000 fast, there's your safety portfolio, which is fairly safe, doesn't change a lot in price, and is fairly liquid that you can convert to cash very quickly. Well, so when we talk about real estate, I get that you say, I want a diversified portfolio, but does everything have to diversify? Can it solve another issue? For example, you might have a high correlation between these two amounts, but when this turns down, your income stream stays constant, right? That you're saying, I want this to be the income stream. Then you don't really care too much about the valuation as long as the income stream is resilient to the change in valuation over here. You're going to build up cash, and this is not going to just do this. This is going to do this. Well, there, deploy the cash. There, deploy the cash. So as the cash builds up, deploy the cash. Shit goes wrong in your life, there's your safety allocation, right? Figure out what role it plays in your portfolio first, and then determine whether you care if it's diversifying or not. Certain subset of people who believe government should be run efficiently, almost like a company. You've actually said this yourself in the past. But a government entire purpose is to serve the people. It's a service, not a profit-making venture. And the people who think that it should run profitably are usually the wealth cohort who are unhappy with their tax rate. Can you recognize the bias? Well, let me see if you can recognize the difference in these two statements. I get what you're saying. And this is a long-running debate. A government is not a business. It shouldn't be run like a business. It should be run business-like. It should be run with business principles. It may not have the same goal, which is maximization of profit, but it should have and corporations have a more modern philosophy than maximization of profit. It's maximization of stakeholder value. But they do recognize that there are multiple stakeholders, not just shareholders. That if you make employees happy, as Costco shows us, it does have an effect on the bottom line. So it's not just about maximization of profit. There are many ways to maximize profit. And if you maximize stakeholder value, you can maximize profit. The first thing you would do is use business practices to say, well, who are the stakeholders here? What is the service or thing that we're delivering, and how do we measure the maximization of that value? How do we measure whether we're doing it efficiently? Now, let's say we have a company. I'm going to give you a company example where something is not cool in a company, but perfectly fine in government. This company has a number of executives that are in charge of certain things. And we're going to call this a nonprofit. And there's a village over here in which they have to say, okay, well, how do we deliver a supply of water to this village? How can we do something to get water, fresh water to this village? If we can do that, we can really lower the malaria and disease count in this area over here. So we're going to need some kind of geological survey. And for this executive, there's a geological survey company that approaches this executive and says, we can get that done. We want this job. If you don't give us this job, what we're going to do is we're going to go to this private school over here and make a big donation to make sure your children are evicted from the school. We're going to make a big donation over here. That's illegal. That's bribery. The executive accepts it. That's accepting a bribe. That's a bribe. Now let's change it. This is a government official. This is a lobbyist. This is another candidate. Hey, we want this contract. My company that I represent wants this contract over here. They're willing to fund this candidate in the primary against you in the next election. Okay, off you go. We'll give it to them. Perfectly fine. Perfectly fine. The lobbyist made his case to the lawmaker. The lawmaker says, "Well, I heard them out, and it was fine." But this is the threat: is we will fund either the opposition party, or we will primary you. That's the threat. Perfectly fine. But in a company, my God, people are going to jail. You see the difference? You can serve the interests of society without that. That's the problem. That's the problem. The lawmaker wants to keep his job, wants to get reelected, period. And the lobbyist says, my company represents this many voters in your community. We get what we want, or you don't get to keep power. Even if it's the wrong thing to do, but the right thing to do for the politician, I guarantee you it'll be the right thing for the politician. It's been a very long time now where your elected officials don't really give a shit about you. It's not about you. It's about them and power. And after they're done their tour of duty and power, then they'll take some board seat position somewhere, get paid $100,000 a year for every board they sit on, maybe hit the speaking tour, make some money there, maybe join a law firm, or maybe join a Washington consulting firm or a lobbyist firm. And that's where the big money is. That's where the big money is. It's incestuous. When Trump calls it a swamp, it is a swamp. It is a swamp. If business operated that way, oh my God, people are going to jail. They're going to jail. And I think that's what we mean by run government more like you would run business, by the same rules. It doesn't mean that you have to maximize profit. A government should not be in the business of profit. It should be in the business of maximizing its value to stakeholders. And who are the stakeholders? Well, you list your stakeholders, and then you say, look, this shit here that I just described that would throw any business executive in jail, but politicians get a pass on all that shit has to end. And I think that's what people are talking about when they say we have to end this system of grift that happens in Washington. Because all of your elected officials don't make a lot of money, but when they go to the private sector, they can make a lot of money. But they got to treat certain companies right. If our company, if this company that I represent says the lobbyist, gets what they want, I'm hearing board seat, I'm hearing something, but I guarantee you that person who's been very friendly to this company, when they're done their tour of public service, goes on to very lucrative private service. Right? And how do you afford this person's big salary in the private sector is you've got to charge the government money today to afford this outflow in the future. So you are, as a taxpayer, in effect paying all of these private salaries by the amount of overpaying you're doing today. That's what it means to run government like a business, is just hold it to the same rules. If you'd go to jail as an executive for accepting money for something like that, then you should go to jail as a politician for something like that. And that kind of thing is just a bribe being funneled through a lobbyist being called lobbying. That's all that is. Lobbying is just bribing by a more comfortable name. It's good for the politicians, but don't you dare do it. Do you see that is something that can be cleaned up, right? Doesn't, just because we say run it like a business doesn't mean we say hard efficiency and profit and increasing earnings per share. Your earnings per share is the quality of life of the citizens you have, and if you can deliver a higher quality of life at a lower cost, boom, there's a business measure that you can lean into. Neutral rate, already talked about neutral rate. Why are these comments repeating? But they are repeating, and that is the end of it. That is the end of it.